Welcome back to TradFi and Bitcoin Club. So basically, the today's session will be about the recent film by Varrun Sukhraj, where he discussed about the problem of the great Indian illusion that he sees in the banking sector of India. Uh, I saw this video. Most of the people here who are in the club, I think those those people also saw this video. Uh, the idea is basically I would summarize all the things that are discussed, or not all the things which from my perspective, whatever I can and whatever I understood from the video. Maybe I have missed some parts. So I think I have given the links in the announcement. So if you want, you can go watch it. And so basically, the goal of today's session is uh, like discuss the problems, whatever that are discussed in the YouTube video, and then brainstorm and pitch the creators of this film about Bitcoin as a solution to the problem. So yeah, let's start. So starting from the Great Indian Illusion, as the name goes, Great Indian Illusion, and can Bitcoin be the exit? So this is a film, short film by Varun Sukhraj. Uh, at the end of the video, he comes ahead and talks about, hey, like these are the problems that are there in the system, in the banking system, but I currently don't have a solution. So the idea of this session is basically go forward and pitch Bitcoin as a solution. And yeah, that's the overall agenda of this session. So the documentary basically talks about banking, public money, debt, write-offs, depositors, farmers, regulators, and power, like all these things. And what we try at the end of the session is basically how Bitcoin can fix this. Then, so as we all know, basically, these banking system is highly dependent on trust, right? Versus Bitcoin, where it's trustless. So banking is fundamentally like a trust-based system, but like you need to trust bank to safeguard your deposits, the bank trusts the borrower to repay, the public trusts regulators like RBI to monitor the system. Then, like in the event of default, government is expected to protect depositors. Then the courts are expected to enforce recovery. So like all these things are dependent on trust, and you are trusting the system when you deposit your money in a bank. But in case of Bitcoin, it's like the trust layer just goes off, and as we commonly say, like do not trust and verify. So in banking, the system only works if institutions behave honestly, but in Bitcoin, the monetary policies or monetary rules are verified by the network. You do not need to trust a like central bank or any institution to like keep your money safe. Now, coming to the one of the problems that were discussed in the video is basically public money and private losses. So one of the strongest moral questions in the film was like when big loans go bad. When I say big loans, I mean like the Malias and the Modis, like the Lalit Modi and Vijay Malias of the corporates. They go bankrupt, and essentially they don't pay off. So in this case, the losses are socialized, like the losses are passed to public. Like we don't uh, we don't have a direct impact of this, but we see indirect impacts of like large loans going bad in our day-to-day life, because essentially the borrowers or the depositors of these banks are paid via money printing. So that's how we as a public face this bad, like when big loans go bad, essentially it's the public who bears losses. And another thing is, like, borrowers often face unequal treatments during financial crisis. So, for example, if there's a financial crisis that is happening in the economy, many large borrowers can refinance or restructure and whatnot. Like, they have all the options open. But in case of small borrowers, we don't have any such kinds of scenarios possible. Like, I remember government tries to do some things from their end. Like, I remember when it was COVID lockdowns, government came out and said that, hey, like, even if retail individuals don't pay EMIs for 3 months, please do not put them into NPA. Now I'm not sure exactly on the numbers, but yeah, there are people in the call like Amol and who belong in the banking space, so feel free to correct me. But yeah, but like 3 months is not a very not an ample amount of time when we consider it to the corporates or the big borrowers like corporates. They can restructure, they can refinance, they can like announce bankruptcy and whatnot. They have all these sorts of way outs to basically bypass this thing. Then coming to this willful defaulters versus ordinary borrowers. So now the definition of willful defaulters. This is very like, I found it very crazy when I heard about this in the video. So what is basically willful defaulter? So willful defaulter is basically a person who has money, but he chooses not to pay. So it's crazy. Like, there was a bankruptcy code brought by the government, and when that happened, um, many corporates came in, and the amounts were higher than 500 crores, and the list was endless. So when this law came in, all the corporates lined up to announce themselves as bankrupt, and um, basically they had the money, but they didn't choose to like repay and things like that. So this willful defaulter is only for corporates and not for ordinary borrowers like you and me. So, like, we face credit damage, like our CIBIL score will disrupt if we chose not to pay. Then, like, uh, many pressures can be implemented by banks, like they can call us, they can email us. Maybe in some rare cases you find people from the bank coming at home. So all these things happen with ordinary borrowers. Then like as I talked earlier as well, large borrowers have this capability to restructure, but we as an individual do not have this capability to restructure in the event of crisis. Then depositor impact. So basically, ordinary depositors bear the brunt of these defaults, facing withdrawal limits, delayed repayments, and resulting in loss of access of their funds during the banking crisis. So these are like couple of things that are different, or which differentiate ordinary borrowers or ordinary depositors with like willful defaulters and larger corporates. Then many of the times, like, we don't like, most of the people who are not in Bitcoin, like, they see bank as safe institution. So whenever they deposit money in a bank, they think that my money is safe. Like, in the film, there are many people uh, which are being shown. So they had their money in a PMC bank. So that bank essentially got into some trouble, and the depositors of that bank had their life savings, their like emergency funds. In the video, there are few people who talk about there's a old guy who is around 72 or 78, I'm not sure. So essentially, when the restructuring happened of that bank, the bank came out with rules like you will be getting your money in like in a span of 8 years, and that old man says that, hey, like I'm 72 and I'm not even sure that I might be living for next 8 years. And essentially, he had all his money in a single bank. So another example was of a lady who had around 35 lakhs in this bank, and she is also not able to withdraw any money. Then there was also an example of another middle-aged man. So he was explaining about how the people are going to get that money back. So basically the system that was or the structure that was made was like I mean it was very very bad. Like you will be I don't remember the right numbers, but it was like this: in the first year you will get some amount, and then in the second and third year you will again get some amount, and then from fourth to eighth year, the whatever remaining amount you have, that amount will yield you around 2.65%. 2.65% in INR, so in Indian rupee. That doesn't even like surpass inflation or even the FD rates. So what kind of restructuring the bank has done? Uh,
So
I think some,
actually,
yeah,
it is like from first year to fifth year. For the first 2 years, there was nothing paid, and when the decision came from first year to fifth year, 15 lakhs will be given in installment, and remaining will be given at the end of 10th year, and the interest will be 2.68%. It was like that.
yeah. Thanks for like
Yeah.
bringing in some real numbers. So yeah, basically that's how these banks have restructured the money repayment, and that was basically like a complete what I can say, a complete cheating by the system to the depositor. So yeah, that's how things work. Then now coming to uh, this thing, when you deposit your money in the bank, as a depositor, most of the people think that uh, bank is just storing my money, but it's not true. So for a bank, economically, it's like you have lent money to the bank. So that the bank basically uses your deposits to make loans or investments. Bank earns money by lending it at a higher rate than it pays to the depositor. So basically, if you are getting 6% in an FD, bank is lending it somewhere at maybe 9, 10, 11, 12% and keeping the difference. So this is how the banking model works. But in case of Bitcoin, it's completely different. Like if you have self-custodied your Bitcoin, it is not someone's liability. It is not a promise to pay. It's not a claim on a bank. It's a bearer asset. It's like cash which you are holding in your hand. So it's something like that. Then uh, the video also talks about public sector banks who are privatizing rapidly. Uh, Personally, I don't have a like a good opinion on this. I mean, I'm not the right person to talk about if these public sector banks should privatize or not, because there are many cases where these public sector entities um, are not very, what I can say, are not very efficient. But when they become private, they start becoming efficient. But in this video, they have talked about that these public sector banks were created not to basically maximize profit, but they were created to serve like a larger audience, like rural people, open Jandan accounts, give credit to farmers, then do some welfare stuffs, give issue loans to small businesses, and some smaller priority sector lendings and whatnot. All these things usually a private bank do not target. Like private banks go for profitability, they may avoid these lower income or rural borrowers or risky borrowers from a banking perspective. So in this video, they talked about risks about public sector banks are like merged, continuously being merged into one another. For example, there's an example where SBI has essentially ac- I would not say acquired. I would say like there are different banks like SBH, then State Bank of different state banks of uh, every different state. They essentially got merged into SBI, and this created a larger banking institution. So in the video, they also talked about what if essentially when banks merge, the it start it start to become more and more concentrated. So let's say we remain with some few players, and if one of them goes out of business, then it can basically topple our economy. So this is one of the points that are being discussed in the video, and they argue in favor that essentially this should not happen. And yeah, one more thing I think that I missed is basically the insurance part. So I think most of you might know that if you deposit 5 lakh worth of money in a bank, basically that is insured. But I was like, me and Amol were discussing before this session, like um, basically, and Amol said me that this 5 lakh limit is generally like it doesn't I mean in a usual case RBI does not need to turn on this 5 lakh limit. Something is happened in between. So for example, let's say yes bank went like some things went wrong with S bank, and like we know, I think SBI, Axis, HDFC, all these big banks took some equity positions in the Yes Bank and provided liquidity. So what usually happens if things go wrong, the regulator forces other players in the industry to take positions in the bank which is getting in a bad situation. So in most of the cases, this 5 lakh amount does not even matter. But in the period in between, basically depositors suffer a lot. Like depositors may not be able to withdraw the even the 5 lakh amount. So essentially this 5 lakh is an insurance, but this insurance it triggers very late. So that's how I can put it at the best. So yeah, that was one of the point. Then yeah, now coming to farmer credit versus luxury credit. So in the video, they talked about an example where like 100 businessmen from Chhatrapati Sambhajinagar, which is in Maharashtra. These top 100 businessmen, what they did is they bought 100 odd Mercedes, and they took a loan So in this case, they were able to finance this loan at a much cheaper cost than the second example is of a farmer who is looking to buy a tractor, and that farmer is basically getting a loan at 18 to 20%, but these businessmen were being able to get the credit or loan at a much higher rate, like around maybe 7-8%. So this is how the credit system works right now. So yeah, that is one of the thing. So morally, it seems like unequal treatment to the people who belong to different pyramids of income. But yeah, this is how the system functions. Then priority sector lending. Now this is very interesting. So in the video, they talk about agricultural credit. So it shocked me when I saw this video, and basically the contributors of this video are people from Maharashtra, and like most of the people. So they talked about how the the difference between agriculture loan as a sector and where are these loans being issued. So basically, when I hear agricultural loans, that loans will be distributed to farmers and like in basically the villages. But what essentially happened is basically these agricultural loans were being issued to agri businesses instead of the farmers. So as a percentage, I'm not able to recall the exact percentage, but a large chunk of this agricultural loan or agricultural credit was being issued by metro city branches. So branches in Bandra, in Mumbai, or branches in Pune. So instead of branches issuing in the Marathwada region or the Vidarbh region. So these two regions are basically agricultural driven than the Western Maharashtra like Pune and Mumbai. So these regions are much more developed than basically metro cities. So in the video they talked about where do you see land in Bandra? You don't see agricultural land in Bandra, right? You don't see like agricultural land in centers of Pune. Like you might see it in the outskirts, but not in the centers. And the loans which were given by the branches of these banks were essentially were in city centers. So it sounds crazy, but yeah, this is basically the thing that was happening in this. That was happening. Then, so how was this happening? Is because agri businesses like in the video they gave some examples. So if you are a small truck, or what I can say, small let's call it a small truck, like if you are a company who is selling those small trucks, or if you are a retailer who is selling those small trucks, and you just mentioned that, hey, my truck is being used to carry agricultural goods, and you get the loan under agricultural schemes. So you benefit of lower interest rates, which were being designed to lend the money to the farmers and people who actually do agriculture, but essentially that does not happen. So what happens is the loans which should go to these agricultural farmers or the people in the lower end of the pyramid, but these loans go to agri businesses, to be specific, like these trucks, or these businesses which are linked to agriculture, or in some cases which are not. So we cannot say that this truck sold will always carry like agricultural goods. 90% of the cases it is not going to happen because truck is bought in Pune, bought in Mumbai. So it is not going to happen that truck is going to like a village and carrying. I'm talking about small trucks or small tuk-tuk or auto kind of things, that thing, and not large trucks. So this is happening basically uh, in the sector which is designed to give loans to the farmers. Then, as I was again, I was talking about this in the previous slide. Basically, privatization of banks and efficiency or loss of public purpose. So I think I have talked about this, where like there is privatization happening of this public bank called IDBI. So uh, this is a public bank, but now the government is looking to privatize it. And the idea that is pitched or that is talked in the video is basically when a bank becomes privatized, it will focus on profits rather than providing services to people in the rural area. So this is an argument which says that public sector banks should not be privatized. Again, I'm not an expert to talk specifically about this because I mean I don't have a strong opinion on this. But yeah, this is what being taught in this film. Then bank consolidation. Again, I think I talked about this as well. So um, many banks are being merged into one another, and if this thing continues to happen in an economy, what will happen? In the end, we will have 4 to 5 large banks, and if even one of them goes into a bad situation, it will the problem will trickle into the whole economy. So it's better to be decentralized and not to be centralized. But essentially, this is what's happening right now. Then service charges. Now, this is very interesting. You might have found out, like, if you try and understand how things are essentially working. Now, essentially, banks have stopped to make money from the interest, from the interest component. They have now a new source of money, and that is called as service charges. And they have a lot of different kinds of service charges like minimum balance penalties, account closure charges, transaction charges, and whatnot, SMS charges, calling charges, and whatnot. The list doesn't end. And it's a pretty good amount that these banks have started to make um, on basically on the service charges. I was discussing with Amol the other day about how these no cost EMIs work. So basically, or not essentially no cost EMI, but how the banking sector is essentially working is, let's say a bank issues loan, and they issue tens and hundreds of loans. Now, what they do is charge a particular small fee, let's say 2%, 3%, 4%, 5%, whatever, on a total loan value. So if they issue 50 lakh worth of loan or 1 crore worth of loan, they charge 2 lakh as a service fee, or some fee on that loan. So they have made their money of 2 lakh upfront. And what they do after they have issued this loan, let's say they issued 1 crore worth of 100 loans, and now they have 100 crore book value, 100 crore worth of loan book. Now, what they do is basically they securitize this loan book into MBS, like mortgage backed securities, and they take out this loan book. And essentially, what is now happening is uh, this mortgage-backed securities are being bought by like pension funds or mutual funds institutions to have an access of continuous like income. So that loan book is now directly being bought by pension funds or mutual fund institution, or in some cases the individuals as well. So this is happening, and banking system is now making money from service charges rather than uh, like the interest of a particular loan. So this has started to happen. So the documentary argues that basically the service charges can become a hidden burden on ordinary people, where like the small fees are being charged. So there was an example where um, a person in Tamil Nadu, he basically goes to the bank and asks the bank to close this account, and the bank takes closure fee also when he tries to close the bank. So all these kind of things are being happening in the system. Then this starts to act as a friction who are forced into the banking system. Uh, like the argument which is made is basically banks are here to serve the people, but with all these different kinds of fees which are being charged, is a friction on the people who are forced into this system. So here, like one of the point that came to my mind, here comes Bitcoin. Bitcoin does not impose any like, fees if you are just holding. Obviously, to run the system, a transaction fees is levied, and that is fair. So yeah, and that is also very transparent. So if there are if there is a good number of transactions that are happening, and congestion is in the network, so network automatically charges higher number of sets, and when there are lower transactions, network again switches to low transaction fees. So this is this is a good way to like have a what I can say, have a look one-on-one with banking system and Bitcoin. Bitcoin is basically charging you more when there is much more congestion, and in the other thing where this banking system charges you uh, like irrelevant, like they have their own set of charges which are independent of congestion or the customer number of customers and whatnot. So it's a flat fee. Then coming to the 13th slide, RBI and regulatory accountability. So in the video, the basically the PMC bank case discussion raises a major question where if warning signs existed, why didn't intervention came late? So in the video, there were some whistleblowers which went to RBI and they said that, hey, look into this bank. This bank is not in a good situation, but RBI came in very late. So regulators always are late, and that is what being talked about. So then information asymmetry, they may not see everything. Like this thing is being talked in the video, like that whistleblower reported to the RBI, and then RBI essentially sent an email to the bank and asked the bank itself to review what's happening in the banking system. But what if the top management is doing a fraud? And in most of the cases that has been happened, the top management has gamed the system. And if you as a regulator are sending an email to a bank, most probably they are not going to do anything, and that's what happened in case of PMC. So yeah, the basically the argument is regulator is not doing their part of work, and they are failing to do um, to protect the depositors or in this game. Then in case of Bitcoin, what I think is basically Bitcoin does not depend on a regulator. It's a trustless system where nodes verify rules continuously. So you do not need to verify, or sorry, you do not need to trust any single institution. Then coming to banking versus Bitcoin risks now. So in traditional banking, like there are risks like NPAs, fraud, withdrawal limits. Also, one more thing, like in the video, the at a point in a video, these two guys, Vijay Mallya and if I'm not wrong, that was Lalit Modi. I'm not sure if um, about that person, but I think that was Lalit Modi, and he came on camera and said, "Hey, like we are the biggest people who looted India." Uh, I'm not sure about the wording, but yeah, they came on camera and talked about we gave the Indian banking system, and we are now freely moving in these specific different countries and enjoying our lives. So yeah, that is the thing. Then in Bitcoin, basically the risk is you losing your keys. So you should be much more responsible when you come into Bitcoin. Then the basically Bitcoin changes the risk management landscape, emphasizing personal responsibility or institutional trust. So basically, the Bitcoin was built as an exit to the system, but like there are still people who might not have the capability to do self custody and whatnot. So there are institutions, but yeah, that's the thing. Then fiat versus Bitcoin, and Bitcoin as a like savings. Okay, savings technology is the next part. Then fiat versus Bitcoin, credit expansion. This thing can be like Bitcoin prevents us from this because Bitcoin is like fixed supply 24/7. So like Bitcoin helps us to hedge against this debt crisis. Again, because of the fixed supply, we can be sure that all of these risks are being covered if we invest in Bitcoin. Then last slide, Bitcoin as a savings technology. So basically Bitcoin will empower individuals. It will empower families who do self-custody, and uh, it is a path which is basically which will provide you an exit from this financial system. So at the end of the video, the the creator comes in and talks about, hey, yeah, these are all the problems